Hello, and a very warm welcome to everyone tuning in. Whether you're on your morning commute, enjoying a coffee, or winding down for the evening, we are delighted to have you with us. If you enjoy deep dives into the financial world delivered in a soothing conversational style, please consider subscribing to our channel. We bring you the latest market insights without the noise, helping you make sense of the numbers.
Thanks, Joe. It's really great to be here again. I was looking at my portfolio this morning, and I have to say, there's a lot of red ink where my streaming stocks used to be, specifically Netflix. I feel like just yesterday everyone was talking about it hitting all-time highs, and now it feels like the sky is falling. What is going on?
It's not just you, Jane. A lot of investors are asking that exact same question. As of today, January 6th, 2026, Netflix is trading right around $91 a share. Now, to put that in perspective, the stock hit a 52-week high of just over $134 back in June of last year, 2025. So we are looking at a correction of over 30%. That is technically a bear market for the stock.
30%? That's massive. I remember hearing about a stock split recently. Did that have anything to do with the lower price, or is this a genuine drop in value?
That's a great distinction to make. Yes, Netflix did complete a 10-for-1 stock split back in November 2025. So when you see the price at $90, it's psychologically much lower than the 900-plus range we might have seen pre-split. However, the 30% drop I mentioned is adjusted for that split. The value of the company itself has shrunk. The split made the shares more accessible to retail investors, folks like you and me, but it didn't stop the selling pressure that started accumulating in December.
Okay, so the pie was cut into smaller slices, but the whole pie is actually shrinking. Why? Is it just that people are tired of subscribing, or is there something bigger happening at the corporate level?
It is definitely something bigger. The elephant in the room, or perhaps I should say the dinosaur in the room, is the massive controversial merger news that dropped on December 5th. Netflix announced a bid to acquire the bulk of Warner Bros. Discovery's assets. We are talking about an enterprise value of roughly $82.7 billion.
Wait, $82 billion? That sounds astronomical. Warner Bros. Discovery. That's HBO, Harry Potter, DC Comics, right? I thought Netflix liked to build its own stuff, not buy other people's headaches.
Precisely. That is exactly why the market is freaking out. For over a decade, Netflix's strategy was organic growth. They built Stranger Things, they built The Crown, they built Squid Game. They avoided big, messy acquisitions. But this move signals a fundamental shift in their DNA. They are trying to buy a legacy media giant that is famous for having a lot of debt and a lot of complex moving parts.
And the market hates uncertainty. But surely owning Harry Potter and Batman would be a good thing for Netflix. Why is the stock tanking on that news?
It's the cost of the meal, Jane. To finance this deal, Netflix has secured a $59 billion bridge loan. That is a staggering amount of debt to take onto a balance sheet that was finally starting to look pristine. Investors look at that debt load and they see risk. They see interest payments eating into the free cash flow that Netflix was supposed to be generating for shareholders. Instead of stock buybacks, that money is now going to service debt.
I see. It's like taking out a massive second mortgage to buy a fancy car just when you finally paid off your credit cards. It feels risky. But is it just the debt, or are there regulatory issues too? I feel like the government has been cracking down on big tech mergers lately.
You nailed it. The regulatory risk is the second pillar of this sell-off. The deal is expected to take 12 to 18 months to close, if it closes at all. We have the EU regulators in Brussels and the DOJ here in the US who are very skeptical of media consolidation. There's a fear that Netflix, which already has 300 million subscribers, buying HBO and Warner Bros. Would give them too much pricing power. If the deal gets blocked, Netflix stock is dead money for a year while we wait. If it goes through, they inherit a debt pile. It's a lose-lose situation in the short term for trader sentiment.
That sounds exhausting for a shareholder. You just have to sit and wait. But let's look at the business itself. Aside from this mega merger drama, how is Netflix actually performing? I remember hearing something about their earnings being a bit messy.
Messy is the right word. Let's rewind to October 2025 when they reported their Q3 earnings. It was a double miss in the eyes of some analysts, but the biggest hit came from the bottom line. They missed their earnings per share, or EPS, targets significantly. The culprit was a one-time tax charge in Brazil.
Brazil? What happened in Brazil?
They had to pay about $619 million to settle a multi-year tax dispute with Brazilian authorities. Now, the company says this is a one-off event, and excluding that charge, they would have beaten estimates. But when you combine a $600 million tax bill with a slightly lower operating margin guidance, investors get nervous. It raises questions about what other regulatory or tax surprises might be hiding in their international markets.
That makes sense. If you're a global company, you have global problems. I want to ask about the commercials. I've noticed a lot more people I know signing up for the cheaper plan with ads. Is that helping them make money, or is it hurting them?
That is the multi-billion-dollar question. The ad-supported tier is growing incredibly fast. In fact, recent data shows that over 55% of new signups in available markets are choosing the ad tier. On the surface, that sounds like a success story. Volume is high.
But volume isn't everything if the price is low, right?
Exactly. The concern is monetization lag. Netflix has all these eyeballs on the ad tier, but they are still building out the advertising technology to sell those ads effectively. Co-CEO Greg Peters has admitted they have considerable work to do to maximize ad revenue. So you have a situation where users might be downgrading from the $15 or $20 ad-free plan to the cheaper ad plan, but Netflix isn't yet making up the difference in ad sales. That is called cannibalization, and it hurts the average revenue per member, or ARPU.
So they are trading high-paying customers for customers they hope to monetize later. That sounds like a risky transition period. Is there any good news? I mean, I'm still watching. Stranger Things is coming back, right?
There is definitely a bull case here, and it revolves around content. You mentioned Stranger Things Season 5. That is the massive holiday release that everyone is banking on for the Q4 numbers. Along with Squid Game Season 2, which dropped late in the year, the hope is that engagement numbers will be through the roof when they report earnings on January 20th. If those shows drove a massive spike in subscribers, the market might forgive the debt concerns for a moment.
And what about that WWE deal? I remember my nephew talking about wrestling moving to Netflix.
Yes, starting this month, January 2026, Netflix becomes the home of WWE Raw. This is their big play into live entertainment. It's designed to reduce churn, that is, people canceling their subscriptions. You might binge a show in a weekend and cancel, but wrestling is on every week, 52 weeks a year. It's a sticky product. If the WWE fans migrate to Netflix and stay, that stabilizes the subscriber base significantly.
Okay, so we have a tug of war. On one side, we have the bear arguments, the massive debt from the Warner Bros. Deal, the regulatory uncertainty, and the tax hit in Brazil. On the other side, the bull arguments, Stranger Things, WWE, and continued subscriber growth. What are the experts saying? Are they telling people to buy the dip or run for the hills?
Sentiment has definitely soured. Just yesterday, we saw CFRA downgrade the stock from buy to hold with a price target of $100. They specifically cited the Warner Bros. Discovery deal risks. Seaport Research also downgraded them to neutral, worried about valuation. The consensus seems to be wait and see. The stock is trading at roughly 25 to 30 times forward earnings, which isn't historically expensive for Netflix, but with the added debt risk, it's not exactly a bargain bin steal either.
So if I'm looking at that $91 price tag, I shouldn't just assume it's a sale? It could go lower?
It certainly could. If the Q4 earnings on January 20th show that the ad tier revenue is still lagging, or if the guidance for 2026 is soft, we could see the stock test the $80 level. Remember, markets often overshoot. When people are scared, they sell first and ask questions later. The uncertainty regarding the 18-month regulatory review for the Warner deal is a wet blanket that could sit on the stock for a long time.
That is a really helpful visual, a wet blanket on the stock. It's dampening any excitement from the new shows. Joe, before we wrap up, I have to ask about the competition. Is Disney or Amazon doing anything that is making this harder for Netflix?
Always. The streaming wars haven't ended. They've just entered a new phase. Disney is aggressive with its bundles. Hulu, Disney Plus, and ESPN. Amazon is leveraging its Prime ecosystem. But interesting enough, this Warner Bros. Deal was partly a reaction to that competition. Netflix felt it needed a deeper library, HBO prestige drama, DC superheroes, to compete with Disney's Marvel and Star Wars. In a way, Netflix is admitting that their own content machine, while great, might not be enough to dominate forever without buying established IP.
It's like they're admitting they need the old guard to survive the new world. Irony at its finest. So what should we be watching for in the next few weeks?
Mark your calendar for January 20th. That is the Q4 earnings call. We need to watch 3 things. First, the subscriber numbers. Did Stranger Things deliver? Second, the ad tier revenue. Are they finally making money there? And third, any updates on the Warner Bros. Deal, specifically regarding the breakup fee or regulatory conversations. If they sound confident about the deal closing, the stock might stabilize. If they sound hesitant, expect more volatility.
Got it. January 20th. I'll be tuning in. This has been such a clear explanation, Joe. I feel much better understanding why my portfolio's down, even if I don't love the red numbers.
Knowledge is the best hedge against panic, Jane. And for our listeners, we hope this deep dive helped you understand the complex machinery moving Netflix's stock price right now. It's not just about good shows anymore. It's about debt, taxes, and global regulators. If you found this helpful, please do subscribe to the channel. We'll be back with a full breakdown of those earnings after January 20th.
Thanks for listening, everyone. Stay curious.
Take care and happy investing.